All right, stop me if this sounds familiar. You're scrolling through YouTube, and some 22-year-old is telling you how they made bank trading stocks. Maybe they're showing off their flashy car or some screenshot of their brokerage account. Here's the thing. They're not telling you about the times they lost their shirt. And trust me, they did. I've seen it a million times. But let's be fair here. Trading in the stock market isn't all bad. It can be an incredible way to build wealth if you know what you're doing. The problem is, most people don't. Today, I'm giving you the real talk about trading stocks. No fluff, no BS. We'll cover the pros, the cons, who can actually succeed in this game, and smarter alternatives if trading individual stocks isn't for you. By the end of this video, you'll not only know the truth about stock trading, but you'll also have a clear game plan to build wealth, whether you want to trade or take a more passive approach. As Warren Buffett says, risk comes from not knowing what you're doing. Let's make sure you know exactly what you're doing. Let's start with the good stuff. Trading in the stock market does have some serious upsides, when done right. Here's why it's so appealing to so many people. First, they offer high potential returns. If you pick the right stock at the right time, the returns can be massive. Think about the early investors in companies like Tesla, Amazon, or Apple. A $1,000 investment in Tesla back in 2012, that would have grown to over $200,000 in just a decade. That's the kind of wealth-building potential that gets people excited, and for good reason. Second, you have a chance to own companies you believe in. When you buy a stock, you're not just throwing money into some abstract idea. You're buying a piece of a company. If you believe in a company's mission, its leadership, or its products, owning its stock allows you to share in its success. For example, if you're passionate about clean energy, you can invest in companies driving innovation in that space. Third, let's discuss the learning opportunities. Trading individual stocks forces you to learn about business, economics, and the markets. You'll start paying attention to earnings reports, market trends, and even broader economic indicators. It's like a crash course in how the world works, and that knowledge can be incredibly valuable, even beyond investing. Fourth, flexibility and control. When you trade individual stocks, you're in the driver's seat. You decide which companies to invest in, when to buy, and when to sell. Unlike mutual funds or ETFs, where someone else decides what's in the portfolio, trading stocks gives you complete control. Next, potential for passive income through dividends. Some stocks pay dividends, regular cash payments to shareholders. If you build a portfolio of dividend-paying stocks, you can create a stream of passive income over time. It's not just about capital gains, it's also about cash flow. Lastly, it's accessible. Thanks to commission-free trading platforms like Robinhood and Webull, getting started in the stock market is easier than ever. You don't need a ton of money to begin, and fractional shares let you invest in big companies with just a few bucks. But here's the thing. While the pros are real, they come with strings attached. The same things that make trading exciting, like high returns and flexibility, also make it risky. And that brings us to discuss the reality of trading individual stocks. Now that we've covered the pros, let's talk about the other side of the coin, the risks. Because while trading stocks can be rewarding, it's not as easy as social media makes it look. First off, even the pros struggle to beat the market. Studies show that over a 10-year period, about 80% of actively managed mutual funds underperform the S&P 500. These are professionals, people with MBAs, access to cutting-edge research, and millions of dollars in resources. If they can't consistently beat the market, what does it mean for us mortals? Second, trading individual stocks is risky. Stocks are volatile. They go up, they go down, and sometimes they crash hard. Remember Enron, Blockbuster, Lehman Brothers? These were major companies that went to zero. If you're not diversified, one bad stock pick can wipe out a huge chunk of your portfolio. And let's not forget the emotional toll. The stock market messes with your head. When stocks are up, you feel like a genius. When they're down, you feel like an idiot. Fear and greed drive most beginner investors, and that's a recipe for disaster. You'll panic sell when the market drops, and you'll chase stocks when they're already overpriced. That's how most people lose money. So, what's the takeaway here? Trading individual stocks is not impossible, but it's incredibly difficult. It's a game that requires time, knowledge, and emotional discipline, 3 things most beginners don't have. So, who can actually succeed at trading stocks? Now let's be fair. Not everyone fails at trading individual stocks. Some people do succeed. But who are they? Let's break down some of the things you'll need to have. Number 1, disposable income. If you're living paycheck to paycheck, trading stocks is not for you. You need to have money you can afford to lose. And I mean lose. As I always say, if you don't know what to do with your money, don't invest it. Pay off your debt first. Number 2, education. If you have a background in finance, economics, or business, you're ahead of the game. But even if you're not formally educated, you can self-educate. Read books like The Intelligent Investor by Benjamin Graham, or One Up on Wall Street by Peter Lynch. Knowledge is power. Number 3, time. Successful stock traders don't just wing it. They spend hours researching companies, analyzing financial statements, and staying on top of market trends. If you're juggling a full-time job and a side hustle, you probably don't have the time to do this well. Number 4, psychological resilience. The stock market will test you. It'll go up, it'll go down, and it'll mess with your head. If you can't handle seeing your portfolio drop by 20% without panicking, individual stocks are not for you. Number 5, patience and discipline. The best investors aren't chasing quick wins. They're playing the long game. As Peter Lynch said, the real key to making money in stocks is not to get scared out of them. So, if you've got the time, the knowledge, the money, and the mindset, you might have a shot at trading individual stocks. But let's be real. That's a small percentage of people. Which begs the question, are there smarter alternatives for beginners? If trading individual stocks isn't the move, what should you do instead? Here are 5 smarter, more reliable alternatives. First on the list, index funds and ETFs. This is the no-brainer option. Index funds and ETFs track the performance of a market index like the S&P 500. They're low-cost, diversified, and have a proven track record of outperforming most active strategies over the long term. As Jack Bogle, the founder of Vanguard, said, "Don't look for the needle in the haystack, just buy the haystack." Second, target date funds. These funds are great for long-term investors who want a hands-off approach. You pick a fund based on your retirement date, and it automatically adjusts its asset allocation as you get closer to that date. It's simple, effective, and stress-free. Third, robo-advisors. If you're not into picking funds yourself, let a robo-advisor do it for you. Platforms like Betterment and Wealthfront use algorithms to build and manage diversified portfolios based on your goals and risk tolerance. They're affordable, easy to use, and perfect for beginners. Fourth, dollar cost averaging. This is a fancy way of saying, invest a fixed amount of money at regular intervals. By doing this, you smooth out the ups and downs of the market and avoid the temptation to time it. Lastly, but most importantly, build an emergency fund first. Before you even think about investing, make sure you've got 3 to 6 months of living expenses saved up. This is your safety net. Investing is important, but financial security comes first. So, here's the bottom line. For most people, trading individual stocks is not the way to go. It's risky, time-consuming, and odds are you're not going to beat the market. But that's okay. You don't need to beat the market to build wealth. You just need to participate in it. Stick with low-cost, diversified investments like index funds and ETFs. Automate your contributions. Play the long game. And remember, investing isn't about getting rich overnight. It's about building wealth over time. As Charlie Munger, Warren Buffett's right-hand man, said, "The big money is not in the buying and selling, but in the waiting." So stop chasing quick wins. Start investing smartly. And most importantly, stay patient. Because the market rewards those who are in it for the long haul. Here's my challenge for you. Stop trying to get rich quick. Start thinking about building wealth over time. If you're serious about your future, hit that subscribe button and let's make it happen together.